to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs. We're joined now by our colleagues Carol Massa, Tim Stenovic, and as always, we go cross-platform, TV, radio, YouTube, to digest a market that, Carol, seems to want to try and claw its way higher again.
I know, if they could just figure out a consistent trend line at this point, right? Up, down, up, volatility. That is something we continue to count on. And whether or not you respect the volatility index, I like to keep an eye on it. It's just below 33, but it did go above 34 earlier, so up another 0.7%. But we're back on the VIX, back to levels we saw, I think the highest since about June 13th, and that's when we saw pressure in the equity market. So just wanted to kind of call that out for everybody, Tim.
All right, well, I want to call out home builders today because we're seeing some underperformance there. Right now, as a sector, down about 0.5 percentage point. Now, they were higher in the morning earlier after we got some mixed data on the housing market, but then they moved lower as yields moved higher, particularly, of course, that 10-year yield, which is closely tied to mortgage rates. Taylor, I know I don't have to tell you this. The 10-year yield this month,
huge.
How many basis points is it up?
The most ever this year on record, ever.
75, I think, is what I heard from you just now.
Thanks,
75.
Tim. See, the Cali people, we gotta stick together.
He's been working on the bond market on the weekends, I hear.
I mean, yeah, she's dabbling in crypto mainly, but yeah. Meanwhile, I'm looking at, well, Tim's definitely dabbling in crypto. Check out his tweets at the moment, new crypto show coming up. Meanwhile, I'm looking at what's happening in terms of S&P 500, currently off by 0.1% at the moment. That's only 5 points to the lower, so we're clawing our way back into potentially the green at the moment. The Dow, though, once again is your underperformer, off by 0.3. NASDAQ, up 0.25%, so managing to push on higher. Russell 2000, for once, also in the green. We're up some 7 points.
50-50 split on a sector basis. You're getting closer to 200 names in the green on the S&P 500. So trying to claw back from the depths of the lows earlier this morning. Romain, energy, a big story, of course, coming out of Russia and the flows into Europe. So energy, of course, here within the U.S., a big outperformer, up about 1.7%. Materials and some of the discretionary, and then technology as well, as yields earlier had reversed. That sort of give a boost to these equity markets. Now, of course, yields climbing once again, but actually really sort of helping up at least the top end of that sector. Down at the bottom quickly, the real estate and utilities, of course, some of the big laggards on the day, a similar story to yesterday.
Well, keep an eye here on the utilities. There's a lot of eyes right now on some of those utilities in the southeastern portion of the United States, given the potential landfall of Hurricane Ian overnight. Duke Energy down about 2.5% here on the day. NextEra, Enamera, and Entergy also should keep an eye on that. We should also point out, as far as oil production, about 11% of capacity here in the United States has already been shut down preemptively ahead of that storm. Meanwhile, in the rest of the market, kind of a mixed bag here. You are getting some of the big tech names like Tesla, which are moving higher here on the day. Tesla up almost 2%. Meanwhile, Amazon, Microsoft lower here on the day, as is Alphabet, down about 1% or 2% given the name. And I want to bring your attention real quickly here to Ryder. This is the big trucking company and logistics company. Those shares higher right now by about 17%. This on the back of a Bloomberg News story saying that Apollo might actually be considering a bid for the company. Again, this is according to people familiar with the situation that Bloomberg did speak to. Ryder Systems up about 15%. Other trucker companies like Werner, J.B. Hunt also moving higher here this afternoon.
What's not moving higher is global stocks in general. The All Country World Index is still underwater on the day by about 0.2%. And I just wanted to highlight how far we have fallen. Great chart coming from our team, such as Pete Dieterres, outlining the sell-off that is now, what, $8 trillion in the making from mid-September at the moment. MSCI World members just really getting hammered. This isn't just a US sell-off. This is a worldwide sell-off, Carol.
Yeah, it's also a multi-asset sell-off, if you will. And cryptocurrencies, you know, in particular Bitcoin, we did see it jumping above $20,000, that level earlier in today's session, but back below that. I know, right?
Said that the other day.
Yeah, pretty.
And the day before.
He trades 24/7. It trades 24/7, Romain.
Oh, okay.
Never
Things
takes a
go
break.
up.
It's actually pretty resilient.
How long are they going to stick with that?
We like levels with a lot of zeros. So anyway, nonetheless, we're watching that market, but we're also watching what goes on at some of these specific companies. And FTX losing a top lieutenant, and Sam Bankman-Fried, co-founder, CEO of FTX, catching up earlier on Bloomberg TV and talking about succession plans. Check it out.
I'm going to be here for the long term. I have no plans to leave. You know, that is not something that is on my horizon. And, you know, I would not be, you know, spending a lot of my energy looking at you know, succession planning that was not going to come into effect.
And of course, that's the co-founder and CEO of FTX, Sam Bankman-Fried. Do we all feel better? Do we feel comfortable, like, to know that he's not leaving? This is important, right? This is the company he founded.
Yeah, it is, and it's one of these companies that has emerged basically as a white knight to come in and help salvage some of the crypto companies that have come close to declaring bankruptcy in the sell-off that we've seen this year. But the context there, of course, is that Brett Harrison, who's president of FTX US, announced earlier today on Twitter that he's stepping down as president of FTX US and is going to transition into an advisory role. He was at Citadel before that, but these two guys got to know each other when they were at Jane Street a few years ago.
I mean, what is it now? Kraken's gone as well.
Yeah.
Was it?
Yeah, the president
Genesis?
of Kraken. Yeah.
They're losing a lot of key executives at the moment. What's also, talk about white knights. Romain, you were just outlining the Ryder deal, Apollo coming in, potentially starting to buy up these companies. I wonder what is happening in terms of people looking at the valuations. When we talk about an $8 trillion route, when that starts to bring in people who are flush with cash in one way or shape or form.
Yeah, if you can afford to finance this deal on your own without necessarily having to tap the debt market in an unfavorable way, then why not? Obviously, we know Apollo has deep pockets, and if they do want to do it through a debt deal, they certainly have the means to structure something that's going to be favorable to them. I think you're going to see a lot more of this. I mean, we know a lot of companies are on the back foot right now. They have a big debt load that they're going to have to refinance over the next year or two. And, you know, if you're going to have to pay 10% or more, then maybe it's better just to do a buyout.
Our PE ratios on the S&P and I think the NASDAQ 100 are actually now on a forward basis, Carol, below some of those 10-year averages. Now, an average doesn't mean anything if you're in a new structural regime, and that new regime is yields are higher. So the math doesn't work. But if you just look at the 10-year average, some may say the valuations are more
Can you elongate that beyond 10
priced
years?
than they were.
Where were we in 2011 or in 2008?
Well said.
Or, okay, because I think I know in 2008 we were under 10 on a forward PE, and I think in 2011 we were sub 14, and we're what, like 16 on a forward basis on the S&P?
We're in the range of where people are interested. One of the big calls on the street, we're looking at closer to 15 relative to 18 times is a better entry point. So we're getting there.
Okay, what's the capitulation? Carol, you always know the answers to this. What's the capitulation? What's sort of the floor that brings everybody back?
But isn't this the question we've been asking for weeks, for months? I mean, this is the problem. We don't quite know. But it does feel like there's a lot more nervousness in the market. And I do feel like, I don't know, an informal survey thinks we're getting maybe closer to it, but I don't know exactly what that looks like. And I think until we know, I thought what Charlie Evans said today with a competitor network, that it was interesting that he was talking about maybe, you know, Fed peaking when it comes to their interest rate moves. And I think if we start to get some clarity about when the Fed is done, doesn't mean they're going to start bringing rates down. That to me will be
but he didn't seem to suggest that they were peaking, though.
No, but he did talk about maybe they finish, right? Rate increases come March. It doesn't mean that they necessarily come down.
Yeah.
No? Yes?
I agree with you for once.
Are you sure? Are you sure you heard me clearly?
No.
All right, we're going to continue this conversation, no doubt about it. Our cross-platform coverage. We'll be back to count you down to the close. We call it Beyond the Bell. Our cross-platform coverage, radio, TV, YouTube. We will count you down to the close on this Tuesday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's really funny when we have these conversations. I do feel like we hit on so many things that we've been kind of churning over since the beginning of the year.
Yeah, you're right. And sort of this reset, and Romain kind of hinted at it, the idea of, you know, the forward PE ratio, absolutely, you know, the regime shift in a higher rate environment, right?
Gina Morton-Adams saying that, 70% of companies, if you look at based on valuations, are back to pre-pandemic levels, and she still thinks they need to come down because it is a market reset. If we are in a higher rate environment, maybe a slower growth environment, maybe still inflationary pressures coming down but still there, what does that mean in terms of valuations?
You know what I'm thinking about, right?
What are you thinking
I'm thinking about the E.
You're thinking about
the earnings. Quarter's over soon.
I just lost my...
Oh, that's what's going on.
There we go. Anyway, it's back.
Her headphones are falling out. Well, what I said is I'm interested in the E, the earnings part. And we're going to start to hear about that in a couple of weeks.
Yeah, no, this is going to be really important in terms of the commentary. I mean, you know, if we have CEOs and CFOs and the C-suite coming out and saying, hey, we don't have clarity or we are under severe pressure, I feel like we got a little bit of a warning from the big banks before their testimony. Jpmorgan, set your calendars. October 14th, we'll get their earnings, 6:45 a.m. in the morning.
All right, calendar is set. Let's go to Washington, D.C. now for World and National News and Nancy Lyons. Hey, Nance.
Thanks, Tim. Hurricane Ian is continuing to make its way toward the western coast of Florida. Michael Brennan is acting deputy director of the National Oceanic and Atmospheric Administration.
We're expecting the center of Ian to move somewhere near just west of the Florida Keys and then approach the southwest coast of Florida as we get from Wednesday into Wednesday night and Thursday. And, it could make landfall a little farther south, a little farther north.
Brennan says the warm waters of the Gulf will cause the storm to intensify. Enki Research is already estimating damages in the range of 60 to 70 billion, given the latest forecast. That would make it the sixth costliest U.S. hurricane. The Nord Stream pipeline system is damaged, and Germany believes it's an act of sabotage. Swedish seismologists detected 2 explosions in the area yesterday when leaks appeared almost simultaneously in the Baltic Sea. U.S. Secretary of State Antony Blinken says it's uncertain what happened at this point.
The leaks are under investigation. There are initial reports indicating that this may be the result of an attack or some kind of sabotage, but these are initial reports and we haven't confirmed that yet. But if it is confirmed, that's clearly in no one's interest.
Blinken says the leaks will not have a serious impact on Europe's energy resilience. The House January 6th committee is preparing for its next public hearing tomorrow, but a new poll is raising questions about whether it'll change the minds of many Americans. A Monmouth University poll finds 41% of Americans think former President Trump should be charged with crimes over the attack at the Capitol. 34% say he shouldn't. Another 25% are not sure. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy Lyons, thank you so much. Nancy Lyons, she is in our bureau at 99.1 studio in Washington, D.C., there with World and National News. Behold the Big Mac, a symbol of American soft power and hard currency dominance. Big Mac prices are showing the pain of the dollar doom loop.
Yeah, okay, so...
so much like word candy.
We studied this in business school.
Did you?
Yes, the Big Mac Index. Yeah, it was coined by The Economist. They invented it back in 1986. What it did was turn McDonald's signature hamburgers into a way of gauging currencies. It works because McDonald's is this, global brand. And early on, you travel around the world now, you see kind of everything everywhere. But McDonald's was sort of an early entrant to so many different markets, so it works really well. The index is described as a, quote, lighthearted way to measure purchasing power parity, or the degree to which one country's money can buy the same things as another country's. As such, it's often been tied to living standards, but also can show whether exchange rates may be over or undervalued.
So with the U.S. dollar soaring to the highest level in decades, the Big Mac Index getting another moment in the sun. Analysts at Bespoke Invest calculate that the booming greenback means 53 of 56 countries had a 2021 Big Mac price that was below that of the United States after converting from local currency to dollars, the exceptions being Sweden, Norway, and Switzerland. With the greenback continuing its surge in 2022 and hitting record highs against things such as sterling and the euro, the U.S. currency as measured in burgers looks massively overvalued. There's your payoff.
Okay, so the Big Mac quote represents a nice tight bundle of commodities, labor, real estate, and productive assets. That's according to Bespoke. You said that in a note. Most major trading partner currencies have trended steadily weaker in recent years as measured by the Big Mac Index, end quote.
It's just another way, right, of looking at what's going on in the world. We've talked about the significance of the higher dollar, and I do wonder ultimately what that means in terms of cost of U.S. goods overseas, translating profits from overseas back into dollars here in the U.S. That's going to impact the bottom line. Personally, I'm a lipstick index kind of gal.
Really? Because they're tied to recession concerns, right?
Right. You still buy a lipstick during times of economic. It's a small purchase. We heard that a lot during the pandemic. All right. You are listening and watching Bloomberg Business Week on Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Well, the equity market is attempting to recover from some early session weakness. It is a mixed picture right now with fewer than 43 minutes to go until the closing bell. Let's get the latest on the price action. Bill Maloney is at the Bloomberg Macro Squawk Desk. Hey, Bill.
And good afternoon, Doug. U.S. stocks with a disappointing reversal today as yields continue to drive higher. Dow's currently down 116 points, was up 400. S&Ps are down 6, and NASDAQ still higher by 22. The U.S. 10-year yield at 3.96%. Gold is higher by 8. Oil is climbing, and Bitcoin was higher by 6.6%. Is now trading little changed. Among the main 11 S&P sectors, leaders were energy and their materials. Consumer staples and utilities were under pressure. And leaders to the upside in the Dow, Salesforce and Dow Inc., while McDonald's and Procter & Gamble led to the downside. Big news in the transport space. Apollo Global is set to explore a takeover of Ryder. Ryder is up 15% right now. And in other news, the UK 30-year bond yield surged above 5%. That's the first time since 2002. Wrapping things up, Cal-Maine Foods reports after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Doug.
All right, Bill. And if you have a Bloomberg terminal and you want to get live audio updates on it, the function is SQUA, then the green go key. 19 past the hour, and that is your Bloomberg Business Flash.
All right, Doug, thank you so much. Well, the World Health Organization out with some new research, what they call invisible numbers, about the impact of non-communicable diseases, what to do about them. NCDs, Tim, you're talking about cardiovascular diseases, cancer, diabetes, chronic respiratory diseases, along with mental health. They all together, under that NCD umbrella, cause nearly 3/4 of deaths in the world. The impact on quality of life, the global economy, and global productivity, it's really massive. So we're going to take kind of a look at the healthcare space, the cost, especially when you think about things like higher inflation, factoring that in.
Yeah, I'm really glad you brought up that inflation element, because we know that healthcare is a significant portion of GDP here in the U.S., about 20%. What does it mean when everyone's paying higher prices for things? For that, we turn to Eileen Flick. She's Senior Vice President and Director of Health Technical Services, at Siegel. It's a benefits and HR consulting firm. Eileen, great to have you with us this afternoon. How are you?
I'm good. Thank you for having me.
Well, talk to us a little bit about some of the data that Carol just shared, and the idea of, obviously, these are preventable diseases in many cases. The question is there's the cost-benefit analysis that happens here, right? It costs so much to actually treat these things when they do affect people and they end up being hospitalized in long-term care facilities. How do we start to treat them earlier so it doesn't end up costing as much and so people are healthier?
Well, that is the key. So, I just want to address, before I even get to that, I just want to mention that healthcare is expected to increase next year, and inflation is at a 40-year high. So I do expect it to drive up medical costs over the next year. But there is a lot that can be done to reduce the costs and to treat people earlier. So, benefit plans can do a lot. What you could do is really promote using lower cost settings. You could do things like promote the use of walk-in clinics and urgent care centers for non-life-threatening acute care needs. Anytime a patient is using a hospital-owned facility for care, they generally pay more for services. So there's very many times it may be the only and best option, but there's capabilities and access for alternative care centers, and they've grown tremendously in the past decade. And I think with the pandemic, there's been a lot more promotion. There's been a lot more access to just care outside of the hospital. So the outpatient care in general has just been promoted tremendously.
Those poor, I say these poor urgent care centers, who, over the last year have just been flooded with patients for COVID tests. We certainly have to figure something out so they're not bursting at the seams. Hey, Eileen, you mentioned that inflation is causing the price of healthcare to go up. We're going to see open enrollment, I think, for a lot of companies in the near future. Are we going to see sticker shock as employees at many of these companies when we start to see how much more our premiums are going to go up?
It depends on the plan sponsor. I think the plans should expect, on average, we've seen this in our healthcare cost trend survey. So the survey basically is showing that medical plan costs are expected to increase at an annual rate of 7 to 8% in 2023. Now, we've seen that trends were actually, they had gone down significantly because people were deferring care. And now we're seeing between the inflationary environment and people actually using services, and now there's been an uptick in services. I think that, we're seeing that they're going up a lot. That said, it's not at the same level as what we're seeing for inflation. Inflation, I think the medical care is price inflation has actually gone up just in general. For overall consumer goods, and medical price is probably a little bit behind, and it's behind because of the timing of provider contracting and commercial plans. So I think that it's embedded in those rates to some extent, but it's probably going to increase over the next couple of years.
I wonder what the right conversation is to be having at this point. Healthcare and the costs to society, to individuals, to companies, just to the economy. We've been talking about this for years, Eileen, and I do wonder, you guys are looking at how inflation is impacting healthcare costs. I mean, should we be looking at something like, and I talked about NCDs at the top, I mean, NCDs, which touch so many of our lives, either directly or through people we know, is there something that we can think about in terms of lifestyle, preventive care? So maybe the question to be asked is, how can preventive care impact healthcare costs? Is there a smarter conversation where we have to turn things upside down in how we approach healthcare, where we would get a better outcome in terms of quality of life as well as when it comes to the cost equation?
I mean, definitely, there's definitely opportunity with preventive care. I think we've seen even with the pandemic that there are a lot of people who didn't take their preventive care screenings, and there are people that are now getting diagnosed with late stage cancer. So preventive care just is always a smart thing to do in general. And there's any opportunity you have to get to care sooner is always going to catch things earlier and avoid high cost claim outcomes. So that's definitely a smart thing to do.
All right.
And so doing that, it'll just prevent a high cost claim and improve outcomes early on.
How sticky are, we only have 20 seconds left, Eileen, but how sticky are healthcare costs? Like, do they come down or do they just stay high if they go higher?
There's as sticky as a plan sponsor is in terms of managing their costs, and there's lots that can be done to do that. And so I think, plan sponsor really needs to look at their data to understand what is driving their costs, and using their data, they can come up with effective strategies, to mitigate increases.
Well, great to check in with you. Eileen Flick, Senior VP, Director of Health Technical Services at Siegel. They're an employee benefits and HR consulting firm. She joins us via Zoom from Bayshore, New York. You are listening and watching Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week. You probably are also either checking your phone, going online, checking TV, streaming platforms about what's going on in Florida.
Yeah, we're going to be talking to Mike McGlone in just a few minutes. He's a senior commodity strategist for Bloomberg Intelligence. You might know him from talking crypto, but we're talking oil and what's going to happen if some of these refineries
He's
are in
a
the path of
commodity kind of guy.
Yeah.
All right, we're going to get to him in just a moment. He is there in Florida. All right, first up, though, back to the markets and the trade and big business stories. Here is Doug Krisner.
Hey, Carol, let me pick up on Hurricane Ian. It is poised to become one of the costliest storms in U.S. history, leaving a destructive trail of floods and power failures. And as you just pointed out, it's threatening to slam into Florida's western coastline. Curiously, if you look at the S&P 500 insurance group, it's actually higher by a little more than 0.2%. Reinsurance stocks, I should say, better by more than 2.5% as a whole. Property casualty insurance companies, this is the sub-index, up about 0.6%. Talk about a little irony, I guess. We're seeing a mixed picture right now in the equity market, although renewed weakness in the NASDAQ composite has us lower now across all of the major benchmarks. The NASDAQ composite moments ago had been positive, but right now we're off about 0.1%. Want to touch on shares in Ryder Systems. This is the transportation and logistics company. We are being told that Apollo Global Management is exploring a takeover offer of Ryder Systems, and we are told that any deal would value Ryder at a premium to its current market value of around $3.4 billion. Shares in Ryder right now better by more than 14%. Earlier in the day, we had some hawkish commentary from Jim Bullard, the head of the St. Louis Fed. He's saying that interest rates really have just now gotten to restrictive territory. That was one of the reasons we saw a move up in rates at the long end of the curve. 10-year Treasury, 396. The Dow, meantime, down 0.7%. S&P 500 off about 0.5%. And again, the NASDAQ composite weaker by a little more than 0.1%. I'm Doug Krisner. That is your Bloomberg Business Flash.
All right, Doug, thank you so much. So Hurricane Ian poised to become one of the costliest storms in U.S. history, leaving a destructive trail of floods and power failures in Cuba and threatening to slam Florida's western coastline. We're talking about 125-mile-per-hour winds. I mean, we're just watching this and tracking it all.
Yeah, it's a story about, obviously a story about people in the South.
Absolutely.
In that part of the country. And then also a story about companies as well, and a story about economics and commodities. And for that, we turn to Mike McGlone. He's senior commodity strategist for Bloomberg Intelligence. He joins us on the phone from Miami. Mike, it's good to have you this afternoon. Our thoughts are with everybody who's in the path of this and where it's already made landfall, of course, in other parts of the world. We wanted to reach out to you to get an idea for the economic impact of a storm like this and to really understand what it can do to refineries that are in the path and ultimately the price of oil and the price at the pump.
Yes, Tim, I think that's a good lead-in for this storm. Thank God, at least for right now, it's missing the main energy-producing parts of the Gulf. It's just east of where you have all the major natural gas and crude oil production. So you're actually seeing that in the price of natural gas. It's down on the day. In fact, it's down almost a couple percent because they're already taking out some of that risk, almost 3%. It's the impact of hitting into Tampa, they're saying, is pretty significant, a 100-year storm. But that's where it's a different thing. It maybe means demand for certain things. But from a commodity standpoint, these storms, the main thing is you miss that main production area, you're fine. But also, the whole area is kind of used to it. And that's part of the reason they have a lot of commercial storage and things for it.
Hey, listen, take a step back here, Mike. Tell us where you are right now, what you're seeing, what's going on. You're in Miami proper. Is that fair?
I'm in Miami. It was funny. The producer for the program said when we were going to talk at 3:30, she said, maybe you should do it from outside. And then she said she was kidding. So I was outside a minute ago, but I'm back in my condo. So I'm in Miami, and I'm actually 9 miles from city center. I'm just south. I live in Key Biscayne. I actually rode my bike today. So I was able to get home with a gap in the rain. And the key thing that's happening here is there's actually people coming from the West Coast to Miami to be safe. But the main area and risks here is flooding. So you've seen a lot of places around our office in Brickell City Center using sandbags and and adding good barriers for the tidal surges.
Well, Mike, in terms of what we're seeing in Florida, is it getting better in terms of dealing with these coastal surges? It was a great piece on 60 Minutes just talking about the reefs and the erosion. 90% of the reefs in and around, I believe it is Florida, which has had such an incredible reef for so long, but 90% has been destroyed, and they're trying to rebuild it because that helps with that coastal erosion. But is Florida getting better at dealing with this, or do you feel like it's just getting worse?
Well, I'm kind of have to be in between. This is my first storm in Florida. And everybody warned me about hurricanes. Well, I kind of grew up with tornadoes in the Midwest and had plenty of them up in Connecticut the last 30 years. But my sense from people here is they're not doing much better. The key thing issue is really the flooding. And it seems like we have to do something more here. But people say, oh, it's going to be an issue. I'm like, well, places like Amsterdam and Venice have been dealing with this for hundreds of thousands of years. So they figured it out. So I think it's just the reluctance to put the infrastructure in, but now we need to do it soon. Like where we are in Key Biscayne, the big storm was 1992. Andrew, I'm looking out at Billy Baggs Park. It completely wiped out the park, but then they rebuilt it with indigenous plants, and it actually worked out for the best.
So, Mike, I want to move the conversation bigger to the price of oil and the way that we've seen. We haven't had you on the program, by the way, in a few months. I think the last time we had you was when you essentially, credit where credit's due, called the top of oil. If we take a step back and see where we are right now, last week, and we did see prices move up for the first time at the gas pump for the first time in more than 90 days. So pretty remarkable run of prices moving lower. Give us your assessment of where things are right now.
Well, thanks for remembering a few that get right, because they get so many wrong. But that's part of what I love about Bloomberg Intelligence is our goal is to get it right and to point out why. And when you're wrong, you admit it. So I was too early, but that peak at 130 was the most extended crude oil's ever been. Crude oil futures above its 100-week moving average. And the lesson you learn in commodities is buy low, sell high, and it was that high. And now we're seeing the repercussions of that. I fully expect crude oil to continue down towards $50 a barrel. It has to get cheap. Typically, commodities get cheap before they go back to enduring bull markets. And commodities were the most expensive, most noted crude oil on some measures ever just a couple months ago. Now, what's happening since then? That big pump in energy has accelerated Federal Reserve and other central banks to fight inflation, which is going to be transitory because crude oil right now is the same price as 2007. It's a deflating asset, and it's accelerating the word towards global recession. So what's happening to me is the pendulum swinging back as fast as it swung up, and crude oil should go down fast, and it's taken the global economy with it, unfortunately.
Right. Well, Mike, and just piggybacking on top of that, I've been looking at the Bloomberg Commodity Spot Index. I think it was down to its lowest in 8 months. It is down more than 21% since early June. Does that, to you, signal recession? No doubt about it, or still up in the air? We just got about 20 seconds.
Perfect. Copper tells us we're going to head for a recession. It's down 24% on the year. It was down up about 10%. It's a situation like 2008, but on a global scale, and I fully expect copper to be followed by crude oil, and lumber has been ahead. Lumber's down 60%. Remember, that was a darling just 2 years ago.
Yep. Well, it's amazing how things have changed. Hey, Mike McGlone, stay safe. Senior commodity strategist at Bloomberg Intelligence on the phone from Miami.
Let's go to Washington, D.C. now for world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden is promising to be with the people of Florida every step of the way as they withstand that potentially devastating hurricane that's coming.
The president underscored the need to evacuate the threatened areas.
My administration is on alert and in action to help the people of Florida, and I directed my team to surge federal assistance there before the storm hit. I just spoke with the mayors of Tampa, St. Pete, and Clearwater. I told each one of them, whatever they need, contact me directly.
The president said Governor Ron DeSantis got an emergency declaration when he asked for it, and federal emergency management officials are coordinating with his personnel. In Washington, Irv Chapman, Bloomberg Radio.
The January 6th committee has canceled tomorrow's planned hearing due to Hurricane Ian. It was to be the panel's final hearing before the release of a final report. It's not clear when the hearing will be rescheduled. Senate Republican leader Mitch McConnell says he will support the Electoral Count Act that's being marked up in a Senate panel. The bill aims to prevent a repeat of the 2020 presidential election when then-President Trump mounted a challenge to the results. McConnell says the country needs a a more predictable path to transferring presidential power. California Governor Gavin Newsom has signed new voting bills that he says protect democracy. Posting on Twitter, Newsom says the bill addresses the increase in threats to election officials.
Prevents doxing and harassment of election officials by keeping their home addresses and private information out of the public records.
Newsom signed another measure that would increase ballot drop-off locations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Masser, Tim Stanovic here on Bloomberg Business Week, live in our Bloomberg Interactive Broker studio. We are also streaming on YouTube as we speak, watching the markets, equities off their lows of this session, but still under pressure. In the meantime, a corporate story that caught our attention across this morning by our own Jenny Serene and Hannah Levitt has to do with Jpmorgan really kind of doubling down, if you will, on its dining push.
This is interesting. I was expecting a story about a new benefit added to maybe one of the cards that I already have.
Sapphire.
But
you pay a lot
you
for
gotta
that
get
card.
Got to get a new card for this one,
It's
Carol.
heavy. It's expensive
I know.
on an annual basis.
You can't shred it.
Can't
You have to
shred it.
send it back for them to destroy it.
So
They
how
send you an
about-
envelope.
how
Okay, I'll
about
talk
this?
about this one.
Yeah,
All
let's talk about it.
So Jpmorgan launching a credit card with DoorDash. It's the latest addition, as you said, to a fast group of co-branded deals with pandemic favorite. It's continued to gain against rivals. It's DoorDash's first credit card. It's going to be a MasterCard, and it expands on the relationship that the three companies already have. They've collaborated on credit card perks since January of 2020, and MasterCard and DoorDash began offering benefits together last year. You mentioned an annual fee, Carol. We don't know the details on an annual fee or a launch date or perks beyond that cardholders will be able to earn rewards on and off the DoorDash platform. Who orders that much food?
Wow. When I look at our Amex end-of-year statement, we've certainly ordered a fair amount, especially during the pandemic, but in general.
We do too, but
I feel like with credit cards, I mean,
I
where's
feel
Charlie,
like not enough to get points.
where's Charlie Pellet, who's,
He's on vacation using those hard-earned credit card points to actually get somewhere.
Look at how it's
I think he's
worked
in London.
in the travel industry, right? In terms of those loyalty programs. I don't know. Does it work in this instance? I don't know. I feel like credit cards are getting to be like streaming services. There's just so many that offer so many different things. It's getting to be a lot. And these companies, these financial companies, make a lot on fees and annual fees.
What about the delivery platforms that exist, right? Uber Eats,
Yeah.
DoorDash,
They want
Postmates.
stickiness, right? They want that Amazon thing, right? Where you just go to the platform.
And you can also just order directly from the restaurant, which the restaurant prefers because then they don't have to pay a fee.
I try to do that increasingly.
Yeah, especially
Sorry.
the local places, right?
Sorry, everybody. Anyway, check out this story at Bloomberg.com.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It has been another day of volatility in the equity markets. We have fewer than 13 minutes until the closing bell. The day began with some very hawkish Fed speak. Jim Bullard, who is the head of the St. Louis Fed Bank, was saying that interest rates have only now just gotten restrictive, and he said they need to remain higher for some time as a way of making sure that inflation is under control. We also heard today from the head of the Minneapolis Fed, Neil Kashkari. He was saying the Fed is committed to restoring price stability.
We are moving very, very aggressively. There's a lot of tightening in the pipeline. We are committed to restoring price stability, but we also recognize, given these lags, there is the risk of overdoing it.
Kashkari went on to say that the Fed's current pace of those rate hikes seems to be appropriate, although there was a little bit of disagreement, I think, from his colleague Charlie Evans, who is the head of the Chicago Fed. Evans seems to be a bit worried about the pace of rate hikes. Today in the bond market, long-term rates up a bit. The 10-year Treasury now at 3.97%. We're up by more than 4.5 basis points. But on the shorter end of the curve, a 2-year down nearly 4 basis points in yield to 4.30%. The equity market is now mixed, with the NASDAQ composite holding on to a slim gain. Let's call it 0.1%. The Dow, though, down 0.5%, and the S&P 500 weaker by about 0.3%. Crude oil rallying, WTI in the extended session, 78.55, with a gain of nearly 2.5%. I'm Doug Krisner. That is your Bloomberg Business Flash.
Thanks so much for that update, Doug Krisner. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. Mexican President Andrés Manuel López Obrador is taking steps to increase the military's role in public security. In doing so, he hopes to contain a surge in drug-related violence. But degrading the power of Mexico's drug cartels will require more than that. The Mexican government needs to devote more resources toward identifying and dismantling drug laboratories and address the weaknesses of its criminal justice system. And even more importantly, Mexico should reinvigorate security cooperation with the U.S. and ease restrictions on American anti-drug operations. The U.S. and Mexico have a shared interest in combating drug trafficking and violence. Closer security cooperation is necessary to protect civilians on both sides of the border. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just got about 10 minutes left in today's trading session. Did you just say Disney shutting down?
Yeah, Disney, we're just getting news that Disney is shutting its Florida theme parks tomorrow and Thursday. This is Hurricane Ian bears down on the state.
Yeah, certainly makes sense to be careful, and obviously amid what is expected to be a pretty rough storm. All right, let's get to it. Certainly been a rough year when it comes to the market, certainly if you're trying to be bullish, because it's certainly been one for the bears. Jimmy Lee is founder and chief executive officer at Wealth Consulting Group, $2.9 billion in assets roughly under management. Once again, joining us on the phone from Las Vegas. Jimmy Lee, how are you?
Great. How are you?
You're great, Jimmy. Do you still have $2.9 billion in assets under management?
Are you growing those AUM?
Well, we're trying our best.
What's tricky about this market environment?
You know, it's a very tough time right now, as we all know. There's a lot of confusion out there amongst investors, and I think it's really about yields and how high interest rates are going up. And as we know, everybody's trying to predict, what the Fed's going to do. Are they really going to do what they say? And are we going to have the Fed funds rate go up another point and a quarter? And if that were to happen, is it going to be too late in terms of a potential for any kind of a soft type landing? And will we cause a really bad economic downturn? So I think that's what the debate is right now. Obviously, the market, the S&P 500 is teetering on the June lows. And so the next few days, I think, will be important, not just for equities, but also for fixed income.
So, Jimmy, we love talking to you for a lot of reasons, but one of them is because you're talking to clients all the time. And I'm wondering what your email inbox looks like right now. You know, what's happening? Is the phone ringing off the hook? Are people concerned? What are your clients saying?
I've got some great stories for you. So, you know, I've been in the business since 1995, so for over 27 years. I have some clients that I still work with today that were invested with me through the dot-com bubble back in, 2000 to 2002. A lot of clients that were invested through the financial crisis, 08, 09. And then I will say that there are a few clients that I have personally that I work with that I've only been working with for the last few years that are expressing a lot of nervousness and literally over the last day or two. And so, I think there are, that type of anecdotal evidence, and I'm sure I'm not the only advisor that is having that type of experience. And so what I'm trying to point out is that the investors that have experienced declines much bigger than what we're going through today, because right now at 24, 25% on S&P, it's not even a typical bear market yet, right? But I think that some people that don't have as much experience are starting to capitulate a little bit. So I think we're somewhere between, maybe not panic quite yet, but we're getting close to that emotional, behavior curve where people start to wanting to sell. And so I think it's a really important, and we've been telling all of our advisors recently that to double up on all the communication with existing clients. And for our business, it's also a great time to go out and find new people that need some guidance.
When you say it's not a typical bear market, what, because of all the bouncing around or what?
Well, when you get a typical bear market, I mean, the S&P is down a third or more. Yeah. So we're not even close to that yet. And I'm not saying that this can't turn into that. And I think that's what the debate has been, whether if we go into a recession, that bear market's going to look more like a third or more, right? So is that what's going to happen? And I've been on the side of, I'm hoping it doesn't happen. I think that the consumer is still strong, but, the Fed's trying to regain some credibility for not increasing interest rates sooner. And if they're going to be bullheaded and just kind of destroy the economy at the same time, and we're starting to see some ripple effects, right, worldwide, mm-hmm. with interest rates in different places. I think in places like, Italy and the UK, it's more about sovereign issues versus what's going on here with the Fed. But, we're seeing yields pop in the UK at levels that we haven't seen before in a very long time. Here in the U.S., I can't remember when we had a 4%, short-term interest rate for cash. And also I can't remember when I really believed that buying bonds were a good opportunity. So we've actually added to our
Jeffrey Dunlap is finding some interest in that.
Yeah, well, we added to duration on our bond portfolios too recently by adding some treasuries in the 7 to 10 year maturity range.
Interesting. If you said it's a good opportunity right now to actually provide guidance to newer clients, newer customers, are you getting new money in this environment?
Absolutely. I mean, for us as advisors, money is always in motion during times like this. So
how are you deploying
the pandemic? Well, we're dollar cost averaging. So in my notes, that's one of the things that we're still going back to the old fundamentals, right? Some things that have always worked. So if you got dry powder, I wouldn't try to predict today to be the market low, but adding at today's levels, if you're long-term investors, if you have a 3-year time horizon or longer, is a very smart thing to do. If you're a retiree and you're being forced to sell your investments at a loss because you need to spend on, I think you should go interview a new advisor because you should have a strategy in place that doesn't, force you to do something like that. So a lot of advisors have, reserve accounts set up for spending for retirees. And so I think it depends on the type of investor you are, but certainly for people that are trying to accumulate wealth, these are good times.
You, in your notes that you shared with our producers and our team, you reminded us that on September 22nd, we got a market signal where over 60% of American Association of Individual Investors survey were bearish. In previous readings, when this happened, the average return 12 months later was 33% for the S&P 500. Wow. Okay, yeah, that's a pretty significant metric. How should we be reading it at this point where we're still waiting for full market capitulation? Just quickly.
Again, I mean, that's another sign. So when everybody's bearish, it makes me feel like it's not that easy to make money in the market, whether you want to short it or go long. So that statistic, I think, supports the view that, we could get a pretty decent rally. Now, again, if we get some inflation reports that are less than expected before the year end, and somehow Chairman Powell starts to change his language a little bit to make people think that they're going to pause sooner than we think today, we could have a huge rally. That's with the midterm election. So that's what I would say. So be optimistic and think about the long term.
Which makes me wonder whether Charlie Evans, who talked to CNBC, opened the door a little bit to that. I don't know whether we should read too much into it. I think there's a lot of debate. Hey, Jimmy Lee, always good to talk with you. Founder and CEO of Wealth Consulting Group, roughly $2.9 billion in assets under management. All right, folks, it is time to head over to our TV colleagues, our cross-platform coverage Beyond the Bell on TV, radio, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast with Carol Massar and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, as well as on YouTube. A wild day here, Carol, where it looked like a lot of folks are ready to buy today, at least for the S&P and the Dow. It looks like they're going to end the day in the red. The other indices, though, holding in the green.
Yeah, it's pretty interesting, kind of bouncing around here. I've been looking at the commodity space. I know yesterday we talked about the Bloomberg Commodity Spot Index, which was down, I think, the lowest point in about 8 months, seeing continued selling and pressure on that. Take a look at something like lumber, down 70% since early March. Copper's down about 32% since early March. What does it tell us? Does it tell us, indeed, a recession? We're either in it or it's coming.
Hey, we just checked in with Jimmy Lee, the founder and CEO over at Wealth Consulting Group. They've got close to $3 billion in assets under management. He had some really interesting comments about what he's hearing from clients right now. He's been doing this for, close to 30 years. He's seen the dot-com bubble. He's seen the financial crisis. He said investors who lived through those things, experienced those declines, they're not the ones calling him. It's the newer investors who are calling him. Those are the ones who are right now really nervous. All that to say, he doesn't think we've seen capitulation yet, and we could still see more lows in the S&P 500.
Yeah, I mean, for the young guys, imagine this is the first time you've ever seen rate increases, let alone QT. Could be shock and awe if it's your first time experiencing that. Romaine, I know we're coming up on the closing bells. I think what was interesting is we got some interesting comments out of Gina versus Christopher Smart on PE ratios. If you take out some of the big tech, ratios look lower, except that Christopher Smart then says yields are higher, so you can't do that comparison.
You have to go through some of these individual names. There's some pretty interesting stories here. 143 new 52-week lows within the S&P 500. And Taylor, I'm going to pop quiz you tomorrow here on what some of the free cash flow levels look like with some of these names. The Dow Jones Industrial Average going to finish the day down by about 0.4%, losing about 123 points. The S&P 500 down for a sixth straight day, longest losing streak that we've had on the S&P on a daily basis going back to February 2020, only down 0.2%, but that record is now in. Meanwhile, the NASDAQ Composite bucking the trend higher by about 0.2%, and the Russell 2000 also higher here on the day by about 0.4%. And real quickly, Dow Transports managed to rally pretty hard into the close, largely on the back of airlines and a few other names up more than 1% on the day.
Yeah, that's pretty significant and interesting. You noted, Romaine, the 52-week lows that we're seeing. I'm just going to take a look at the S&P 500. And even though we had some bouncing around and we finished off our lows, still more than 300 names to the downside, 195 higher in today's trade, Taylor, and 5 unchanged.
And we should just jump in and show that we are getting some breaking news regarding the overall record-keeping failures from the SEC, charging 16 Wall Street firms with record-keeping failures. They're suing 16 Wall Street firms for overall, of course, this is likely relating to the WhatsApp saga. SEC firms admitting to wrongdoing, and they agreed to pay over $1.1 billion, Romaine.
Yeah, and just a few of the names here. It includes Barclays, Bank of America, Citigroup, Credit Suisse, Deutsche Bank, Goldman, Morgan Stanley, UBS, and there's also penalties with regards to Jefferies and Nomura, as well as Cantor Fitzgerald.
I know that we'll continue to walk us through some of that other breaking news. In the meantime, we'll get back to some of the individual sector levels as well, Carol. When you think about it, actually is a little bit more green than it was earlier. Auto components, energy, those have been the huge winners for the year, at least when it comes to energy. That narrative continues today. Some of the insurance companies actually surprisingly still up on the day as well, as we've been talking a little bit about the effects of Hurricane Ian. So that is still up about 0.5%. Take a look at the bottom of the screen, and on the day, it's really those interest rate sensitive sectors real estate, utilities, and then, of course, food and beverage and household products. When we're thinking about some of those inflationary concerns, really putting pressure on those sort of low-margin companies as well, Carol.
All right, so let's get to some of the individual gainers in today's session. Carnival Corp holding on to its gain, though I should point out it was up more than 7% at its highs today, closing with a 3.6% gain. All of the cruise lines, whether it was Carnival, Royal Caribbean, or Norwegian, all trading higher. Those travel stocks, including the cruise operators, as well as some airlines and hotels, trading higher, helped by
What do you make of that, Carol? I was actually kind of surprised.
Well, I think, people are trying to look to the future. And I think as we start to see more markets reopen, that we feel like we get a better handle on COVID. China's a big part of this, right? We saw this with the gambling companies.
Yeah.
I think it's pretty significant, but it's that reopening economy. I don't know. You think maybe it's an overtrade? They finished off their highs of the day. So
I like those sound effects. Can someone just loop that and give me a button that I can hit at any moment?
Oh, boy.
We'll get our tech
Be like the morning zoo show.
All right, let's talk to Tesla, also rallying off its highs. It was up more than 4%, 4.6% at its highs, finishing the day up about 2.5%. Electric, which covers electric transportation, Tesla specifically, sometimes is bullish on Tesla, but it is out saying that Tesla's management in an email to employees said the company will be delivering a very high volume of vehicles to eagerly waiting customers during the final days of the third quarter. So some enthusiasm there. Just want to mention Vertex Pharmaceuticals up almost 3% in today's session.
Yeah.
This was topping the NASDAQ 100. CRISPR Therapeutics and Vertex rising after the FDA granted their gene-edited therapy a rolling review, which means it's kind of speeding along the process.
And did you see some of those meme stocks rallying today, like AMC, GameStop, Hertz? Not sure why.
What do you make of that,
AMC was
Romain?
down a lot
Romain, what do you
yesterday,
make of that?
I don't know. I don't know if that's really the reopening trade or the idea that we're going to continue spending, or it's more just people looking at the valuations and saying that there's a long-term story. Who knows? AMC, though, did
like
close
a volleyball,
9% on the day. GameStop up 7%. I don't know.
I don't know. Yeah.
I'm trying to look for a bigger
trade?
story in
Does Tim have
those.
a bigger story?
Yeah.
Well, speaking of big, Tesla might have been higher, Apple was higher, but other mega caps weighed on the S&P 500 and on the NASDAQ 100. Two of those, Microsoft down about 0.4%, Amazon down close to 0.6, a little more than 0.6%. This is the yield on the 10-year continues to creep higher and higher, closer to that 4% mark. And then Duke Energy down 2.5%. You might have seen the news just about 15 minutes ago that Disney's actually closing its theme parks in Florida today and tomorrow. Duke, another important company to watch as Hurricane Ian continues its destructive path toward Florida after making landfall in western Cuba. Duke Energy, they've got natural gas. They do supply and delivery. They operate in the Southeast and the Midwest. Our focus, of course, is on the Southeast. The company did say today that it's mobilized about 10,000 personnel for the impact of the storm. So one of those stocks to watch, down 2.5% today.
And notably, that had an impact on U.S. natural gas. We had Jim Romer, of course, thanks to Taylor's booking, talking to us about why natural gas, the demand erosion from that landfall, and indeed natural gas falling in the U.S. But not so over in Europe, of course. That's all to do with Nord Stream, the concerns about, well, sabotage on some of the gas links in between Europe and Russia. And indeed, that pushes natural gas up higher. We see Brent crude up 2.6% as well on the day, WTI up 2.4%. In the FX space, actually a little bit of a reprieve for the British pound. We saw it bouncing around today. It had been higher, then lower. Well, it finishes at the moment, continuing to trade, but strengthening by some 0.3%. The euro weakening as we get Madame Lagarde likely to speak tomorrow, of course. And we're seeing still some strength in the US dollar. And I mean, the moves really that catch the eye are a continued pressure in the UK on the gilt market. The sell-off continues, 45 basis points on your 30-year. The long end just getting absolutely hammered by that fiscal stance that the IMF is saying should not be taken by any other countries.
It was the end of a record when you think about 12 straight days remain of yields rising.
Yeah.
All of that changes, at least on the front end of the curve, down about 3 basis points here on the 2-year to 431.
All right, we want to get back to that breaking news. A combined $1.1 billion in fines being assessed by the Securities and Exchange Commission here in the United States off the back of that WhatsApp probe. Pretty much all of the major banks that you know and love are agreeing to some sort of settlement of one or another. This includes Goldman Sachs, Citigroup, Bank of America, and Morgan Stanley. Bloomberg's Sally Bakewell standing by right now with a little bit more information. Sally, just give us a quick sense here on the settlement, why the settlement, and how much these companies are paying.
Yeah, so we just heard from the SEC now that they are expected to pay more than $1.1 billion. The probe, began because employees at banks, they had started to use unapproved messaging devices such as WhatsApp. And of course, the pandemic exacerbated that because more and more people were at home. They could use these kind of messaging devices. And that actually ended up spurring a probe by the SEC and the CFTC. It was a very widespread probe. Today, the charges were against 15 broker-dealers for these failures by firms and their employees to preserve electronic communications. And so today we've learned that they've settled with a number of these firms for about $1.1 billion. And if you recall, the first bank to be hit by one of these charges was Jpmorgan in December, where it faced a $200 million fine. And, it's very important for regulators who say that financial institutions, they depend on trust. And record keeping and books and record obligations are a huge part of that.
Hey, Sally, for someone who covers this industry inside and out and all the issues that impact the big banks, and we talked about this also with Sri Natarajan a little bit earlier, what's the significance? Is it that it's not as much as, I think some talked about $2 billion, or is it that the bank's inability to maybe have true oversight of all their employees when it comes to tracking their conversations, which we thought was kind of fixed coming off of the financial crisis?
Right. I think it shows how complex it is when you do have these new messaging apps. And of course, also, some employees, some staff at banks, they might not be fully aware of what the rules are. They might be very senior employees, and what constitutes an unapproved message, as a text. I think we've seen that particularly recently in some things relating to Twitter. Is a text between two very senior bankers or a senior banker in a corporation, is that problematic? And, I think once trying to eke out what falls foul of certain policies and what doesn't has proven very, very difficult. And of course, there are more messaging services beyond WhatsApp. So do we end up with this kind of whack-a-mole situation where they manage to get control of one, but then there is another system that pops up? So I think it really just shows how difficult it is to keep track of these communications within banks, especially when people are now, although Wall Street has invited lots of staff back and is encouraging them to come back, there are still swathes that are working from home.
Sally, finally, just quickly here, does this consider it a win by the SEC?
I think so. I think to the degree that the SEC, it wants to be seen to be tough, of course, on banks, and we are in an administration that also has that same impetus. It is one of the, I think, biggest probes levied against banks for record-keeping lapses. There was a $15 million penalty on Morgan Stanley in 2006, but something so widespread as this and totaling this amount is, it's a serious indication that the improper conduct is going to be hit. It's going to be taken very, very seriously. And also the speed of this probe seems to have moved quite quickly.
Yeah.
So it's perhaps another indication that they're really on top of this.
All right, Sally, great to catch up with you here. Just to recap here, the big breaking news is that the big banking giants have agreed to $1.1 billion in combined penalties for failing to monitor employees who use unauthorized messaging apps. 16 firms agreeing to a variety of fines ranging from about $100 billion down to about $10 billion.
And as for market reaction, just looking at some of the big banks, we're seeing little movement, so maybe a little bit lower here in the after hours. All right, guys, that's a wrap for our cross-platform coverage on this Tuesday on radio, TV, YouTube. We're going to call it a wrap for Beyond the Bell. We'll see you again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Let's get right to Nancy Lyons standing by with world and national news. Hey there, Nance.
Hurricane Ian is expected to make landfall somewhere in southwest Florida tomorrow, with winds that could be as strong as 140 miles an hour. Florida Governor Ron DeSantis says the entire Gulf Coast could feel its effects.
In some areas, there will be catastrophic flooding
and life-threatening storm surge. And so if you're on Florida's Gulf Coast, from Naples all the way through the Tampa Bay area and some of the counties north of that, that could be something that happens.
DeSantis says an estimated 2.5 million people are under evacuation orders. This afternoon, Disney said it plans to close its Florida theme parks tomorrow and Thursday. The January 6th committee has canceled tomorrow's planned hearing due to Hurricane Ian. It's not clear if or when that hearing will be rescheduled. Pro-Moscow officials say residents in 3 of the 4 Russian-occupied areas of Ukraine have voted to join Russia. The Kremlin-orchestrated votes have been dismissed, though, by the U.S. and its Western allies as illegitimate. Facebook parent Meta Platforms says it blocked thousands of fake Russian accounts that spread propaganda about the war in Ukraine.
The social media giant says the group behind the network created 60 websites impersonating legitimate news organizations in Europe. Meta says it used its accounts on Facebook and Instagram to criticize Ukraine and Ukrainian refugees, praise Russia, and claim that Western sanctions would backfire. Meta says it collected about $105,000 in ad revenue from these fake accounts. The company now says it will put that money toward its growing security teams. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nancy Lyons, thank you so much. Carol Massar, Tim Stanovic, live in our Bloomberg Interactive Brokers studio and streaming on YouTube. Well, yesterday, you might recall, we talked with Pete Schlamp. He's the Chief Strategy Officer at Workday. We talked about digital transformation, the changing world of how we work. Well, embracing digital strategies, they are definitely everywhere, including a massive company best known for its industrial construction and mining machines. Tim, we are talking, of course, about Caterpillar.
Yeah, I'm familiar with it. It's my 3.5-year-old's favorite company that exists. I mean, we're talking about the world's leading manufacturer of construction and mining equipment.
Caterpillar tractor.
Well, you are now Arlo's best friend.
On their training ground. It was pretty cool.
Let's get to Augie Redzik, Chief Digital Officer for Caterpillar, who joins us via Zoom from Scottsdale, Arizona. Really great to have you with us this afternoon. Thanks so much for taking the time. When we think Caterpillar, I mean, we are talking heavy equipment. We're talking construction. We're talking mining equipment. I mean, in a sense, this is stuff that's powered by diesel, and it's kind of the antithesis of digital. But talk to me about how you guys harness digital.
First of all, good afternoon, Carol. Good afternoon, Tim. I hope your 3-year-old would like a little motor grader that I have behind me. My kids love it. Look, the digital really enables Caterpillar. I mean, you know Caterpillar's history. Been around 100 years. Kind of invented the track-type tractor and figured out how to put gasoline versus a steam engine, and really kind of changed so many industries since then. We view digital as a big enabler for our dealers and our customers to continue innovating in the new world that we're building all around us. So, what we're doing, namely just my team, we have a team of about 1,400 engineers. We collect data from more than 1.2 million assets that Caterpillar has out in the field. We collect that data. We actually put the data in a useful information. We create services on top of that data, and then we pass information back to our customers so that they can operate their fleet better, so they can know where their equipment is, how hard it's working, and we have many interesting applications we give to our customers and our dealers so they can improve the operation of the fleet.
Well, you know what's interesting too, and I want to just, if I can, just step away from some of the digital work you guys are doing specifically, because you touched about data and how that, data is such an important part of what you do. And one of the things, Augie, that we love about Caterpillar is that you guys are so into collecting lots of data points. And if I could just for a moment, though, tap into what the data points tell you about kind of our broader world, our macro world, which has been a theme that we have been hammering in particular over the last week or so, because we look at inflation, concerns about growth, we're looking at the continued digital transformation of the world and how that can be uncomfortable as we move towards it. When you look at that, and you guys are known for your data collection and what it tells us about the global economy. So if I can just step back for a moment, what does that tell us about our world right now?
Well, obviously, we don't really talk much about data that we collect from our customers. We primarily use this data to help our customers with the applications that they use day in and day out. But certainly, we have increased number of assets out there that keep collecting the data and leveraging that for benefit to the customers. And I can tell you that, the world is continuing to hum along. Our customers, we have growing number of customers using our platforms every day. So they extract more information from us. They use our autonomy solution, for example, more than ever before. So there's definitely desire and an appetite for data to be shared back with our customers in a meaningful way where they can actually leverage the applications that we built for them.
Well, that's what I was going to ask you, in terms of what's top of mind, for your customers, whether it's energy, transportation, construction, farming, which is you guys play into so much of what is our global economy. What is top of mind for them?
Well, look, the key for them is to be able to operate their fleet as effectively as they can. It's important for them to be able to get parts from us, from our dealers. It's important for them to transact with us in a seamless way. So when we look at the investment that we're making in digital, for example, we make investment to help our customers with condition monitoring. So we have a team of people that build very advanced machine learning tools that it can actually take information from, let's say, a mining truck at a mine, figure it out through vast amounts of data that we collect from it, that there's potential issue that may emerge over the next week or so. And if we can get in front of that problem with our customers, save them hundreds of thousands of dollars of unplanned downtime, and actually get the right part and the right service technician in front of the customer in that mine, that it will be tremendously valuable to the customer. So they're looking at these digital technologies that we help deploy to them as a way for them to save on the operational costs, reduce the downtime. That's really important for our customers. You can imagine that each one of these mining trucks, it's tens of thousands of dollars per hour if it's not operational,
right?
For the mining operator. But also, we make it very easy for them to get parts, to get service, to book service, to order parts online. We've just recently shared, through our dealers and dealer network, do more than 10 million part sales every day on our online e-commerce channels. And we expect that to continue growing. So you can imagine making it very easy for our customers to get their spare parts, to get the spare parts in the right moment, in the right time where they need them. And our dealers are there to help customers with that transition.
Hey, Augie, is this also playing into what's going on with climate change? And I'm just curious in terms of the data points, and how is that maybe translating into helping out your customers digitally and ultimately leading to more growth for them?
Sure. In a very simple way, we have a tool we call VisionLink. It's one of the fleet management tools. It's kind of de facto standard in the industry. This tool will tell fleet operators, for example, how much CO2 they're emitting. So it's very simple. If you obviously drill a little deeper, you can see how's your fleet doing when it comes to idling versus operating the engine. And clearly, if you have an idle time, you want to try to reduce it because of emissions that you're going to get with it. And also, you want to just make sure that you extend the useful life of the asset that you have to the maximum. So there are tools that we develop in digital that actually help our customers operate those fleets more effectively.
Hey, Augie, what does this do for stickiness when it comes to customers and Caterpillar machinery? When they're ready to go and actually buy a new piece of equipment for mining or for construction, does having this digital offering, having the data about what they're working on, does that make them more likely to continue to buy a piece from Caterpillar rather than from a competitor? And what does the data show us about that?
Absolutely. Total operating cost is what really matters to our customers. It is critical for us to make sure and demonstrate to our customers that operating cost of owning a piece of machinery from Caterpillar is better than from our competitors. If you look, for example, I'll give you some data. Customers that come to us and start using our digital tools to buy parts, to transact with us, actually end up buying 24% than those that just do it over the counter. And not only do they buy more of what they previously bought, but they also have an opportunity to explore more of what we offer, and therefore they buy more SKUs, things that they haven't bought before. And they also have much broader spectrum of solutions that we can offer them when they see them in nice assorted digital catalog, for example. So to give you some idea of how valuable we think these tools are.
Well, and talk to us about, we've been getting into, Augie, how what you guys are doing can help customers, right, clients, in terms of their digital transformation. How does this, though, the digital transformation that's happening with you guys and focusing on this, how is that translating into growth? And how will it in the years to come on Caterpillar in terms of impacting top and bottom lines?
Yeah, absolutely. So I gave you a data point of $10 million in dealer part sales per business day today. And we expect that will grow 50% in the next 3 years. That's one data point. Another interesting data point is we put a lot of effort and energy in our machine learning capability to give better leads to our dealers. So we use 20 different data sources, obviously data from machine. We look at engineering information. We look at telematics information, data from service. And we collect all of that, and we come up with a very precise recommendation to our dealers to go and visit a customer because we know that there is a particular need going to materialize in a moment. We just started that effort 3 years ago, really. In 2021, we did about $1 billion of closed one, so deal that actually resulted in sale, and we expect that in 2023 already we will be doing about $2 billion in sale.
But during, excuse me, Augie, sorry, as we've been seeing supply chains just, wreaked havoc upon during the pandemic. Did that type of data even matter? Like, did you have the equipment to send to those dealers?
We did. We actually had the best parts availability in 2021. So obviously, there's been a lot of hard work from many people. I know my team is, went all over the world to find the chips that we needed and often had to replace them with different chips, and then did the engineering work to ensure that these new chips will work as effectively as the previous chips. So there's a lot of effort that goes into it, but clearly, when it comes to, for example, parts availability, which is what matters, 2021 was actually a pretty good year. Now, we continue to have challenges in supply chain, just like everybody else in the industry. I'm not at liberty to predict when those will get better. But again, we're doing everything that we can, and I think are doing a reasonably good job.
Well, you know what, and just building on that, in terms of digital transformation, you hear digital, you do think about semiconductors and chips specifically, and we've all had some really smart conversations and thoughtful conversations about where we need to be manufacturing, where we need to get our supplies, and we are increasingly hearing, certainly from a U.S. story, that it needs to be closer to home. And you guys sell, I think, was it roughly about $22 billion in North America, and then I think more than that outside of North America. So when you think about where those supply chains need to be, does it make sense? We talked with the mayor of Columbus, Ohio, Intel making a big investment in that city specifically to build out a semiconductor presence. Is it really smart? Do you agree that we need to be building this closer to where we're selling and for the United States to kind of step up and bring production home?
Well, ultimately, I'm probably not the expert to tell you where the factories should be, but I can tell you that.
But you buy, you need to have access, right?
It's critical for us to have access to chips, absolutely. And if that means that we need to do more in the United States, absolutely, we'll be fully supportive of that. But right now, we're still years away from anything in Ohio coming online. We still have, short-term issues that we need to resolve, and those chips need to come from somewhere else.
Well, I have to say, it's great to check in with you. A few years ago, I did a deep dive on the company, spent some time in the proving ground out in Illinois. I got to drive some vehicle, a tractor. But it's interesting in terms of how this company, continues to embrace technology, including the digital world, the digital transformation. It makes sense whether they're doing it internally or for their customers.
Why don't we do a remote where we do this from the tractor?
I loved it, man. Wear a hard hat.
That's pretty cool.
Self-driving tractors so that you can go to tough mining areas so you don't put people at risk. It's pretty amazing. Augie Redzik, he is Chief Digital Officer over at Caterpillar, joining us via Zoom from Scottsdale, Arizona. Coming up, we're checking in with Steve Case, talking more transformation.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
And it's brought to you by SEI. Visionary asset managers find opportunity where others are challenged. You can exploit disruption's potential with SEI's global operating platform. Find out how at SEIC.com/IMS. We're about 31 minutes past the hour. We had a mixed day in the equity market, a lot of volatility. An early push higher kind of faded after some very hawkish Fed speak. We had Jim Bullard, who is the head of the St. Louis Fed, saying that interest rates have just gotten to restrictive territory and that rates need to remain higher for some time to make sure that inflation is under control. We also heard today from the head of the Minneapolis Fed, Neil Kashkari. He was saying the Fed is committed to restoring price stability.
We are moving very, very aggressively. There's a lot of tightening in the pipeline. We are committed to restoring price stability, but we also recognize, given these lags, there is the risk of overdoing it.
Now, Kashkari went on to say the Fed's current pace of tightening is appropriate. However, a little bit of disagreement with his colleague Charlie Evans, who is ahead of the Chicago Fed. Mr. Evans is a bit worried about the pace of these rate hikes. In the bond market, though, moves in prices were less extreme than what we saw in the Monday session. 10-year Treasury up today by about 2.5 basis points in yield to 3.94. At the short end of the curve, the 2-year falling in late New York, trading by more than 5 basis points to 4.28. In the equity market, we had the Dow down 0.4%, S&P 500 off 0.2%, the NASDAQ comp pushing higher by about 0.3%. I'm Doug Krisner. That's your Bloomberg Business Flash.
Doug, why can't the Fed guys just get along?
I don't know.
I don't know.
Well, I think it's a healthy debate, right?
Yeah,
you don't
it is
want
a healthy
groupthink, right?
No, we don't want groupthink, that's for sure.
Okay.
All right, Doug Krisner, thank you so much. Well, our next guest, a well-known investor, innovator, and author. Steve Case is, of course, the co-founder of America Online, chairman as well, and CEO of Revolution. His investment firm, it backs all kinds of entrepreneurs at every stage of their development. His roughly $1 billion investments in some growth stage companies. You may know them, Sweet Green, DraftKings, Clear, and more. And he's got a new book out.
The book is called Rise of the Rest, How Entrepreneurs in Surprising Places Are Building the New American Dream. We're pleased to have Steve with us this afternoon in the Bloomberg Interactive Brokers studio. Steve, it's good to see you.
Great to be with you.
You know, I was commenting to Carol a little earlier that I said, you know, every time I've interviewed you, basically from 2014 to 2020, you were on a bus.
Yeah.
And this is the second time I've gotten to interview you where you haven't actually been on a bus. This book is about the bus
being
tour.
on a bus.
Yeah, it really is. I mean,
spending a better part of a decade traveling around the country trying to see what's happening in terms of innovation, entrepreneurship in different parts of the country, meeting hundreds of entrepreneurs, visiting dozens of cities, now making investments in about 100 cities. I was just so fascinated by what I saw and so, frankly, encouraged by what I saw. I said, I have to tell the story. I have to share these stories, and that's what led me to write the book, trying to really kind of help people understand what's happening, not just in a few places like Silicon Valley, but all over the country, which I think bodes well for the next phase of innovation in this country.
What are we missing by ignoring what's going on in the heart of the country, Steve?
Well, a bunch of things. First of all, some of the biggest industries up for grabs in this next wave, what I call the internet third wave, like healthcare. Some of the expertise you need, some of the partnerships you need are in the middle of the country. You know, Mayo Clinic in Minnesota is important. The Cleveland Clinic in Ohio is important. MD Anderson in Texas is important. Also, for some industries, like the trucking and logistics industry, getting people who understand that business and are in those communities are important. One of the stories I talk about is in Chattanooga is this company called FreightWaves, kind of does Bloomberg for trucking and logistics. Well, guess what? I didn't know this until we visited with our bus, but some of the biggest trucking companies in America are based in Chattanooga, so it's actually a better place to be for that business than New York City. Or another one, Acre Trader in northwest Arkansas, in Fayetteville. The founder actually was working at a hedge fund in San Francisco, decided to move to Arkansas because his business is basically a platform to invest in farmland. And you need to get farmers to put their farms on the platform. Well, he thought it'd be better to be closer to the farmers and therefore in Arkansas. So there's a lot of these stories that I think surprise people. It certainly surprised me, and I think people reading the book will be equally surprised by how many things are happening in how many different places, most of which you've never visited.
It's not just the East and West Coast, right?
You know what's funny, Steve, is 24 hours ago, Andrew Ginther, the mayor of Columbus, Ohio, was sitting in the seat that you're sitting in right now, and he was basically saying the same thing. And he talked about the acceleration of what happened happened during the pandemic and the way that people moved away from the coast to other parts of the country because they were able to work remotely. You've been doing this and looking at this for what, the better part of a decade at this point. How did the pandemic change the way that people thought about geographies when it came to innovation?
Well, you're right. It was bubbling for most of the last decade. Every year, every time we did another tour, we would see more progress in more places. But the pandemic was a tipping point. It really was sort of when people took a step back and said, where do I want to live and how do I want to live and how do I want to work, and kind of remote work, hybrid work, things like that led to some people deciding to move someplace else. And instead of just being in San Francisco or just being in New York or just being in Boston, which have been the historical, kind of tech hubs, a lot of people moved to other parts of the country, and attracting that talent is critical to fuel those startup communities. Interestingly, over the last several decades, we've seen a brain drain in this country. Most people in Silicon Valley, over 95% of people in Silicon Valley, are from someplace else. They didn't grow up there. They didn't go to school there. They're from someplace else. They went there because that's where the opportunity was. That's where the capital was. And now we're seeing a slowing of that brain drain of people leaving different parts of the country, and a little bit of a boomerang of people returning. And Columbus is a great example, a lot of momentum there.
I feel like, too, when we think about what's going on in the middle of the country, I feel like that when I travel or we travel and we get to something other beyond the East and West Coast, like we just get a different point of view, a different perspective. We talk about stress, the importance of diversity of thought in terms of ideas. How have you come across that?
Totally. Entrepreneurs at the core see a problem they think should get solved and start a company to solve that problem. And you're only going to see problems based on your experience, and that will include where you're living and the communities that you're interacting with. And a great example in the book is in Indianapolis. There's a mom in a suburb of Indianapolis that a number of years ago was concerned about water quality. This is after the Flint, Michigan water crisis. Flint's not that far from where she was. He said, I'm kind of worried that maybe my kids are drinking unsafe water. So she called the water utility and said, I want to get my water tested. They said, we don't do that for consumers. And if we could make an exception, but it costs you like $3,000 or $4,000. She thought that was crazy. So she started a company called 120 Water to test people's water. Initially, it was just for consumers. Now she's actually selling that capability to cities, including San Francisco, to test their water. She would not have had that experience unless she happened to be there and happened to bump into that problem. And that's, again, the dozens of stories in the book are people like that. They just saw something and they said, I'm going to do something about it. And they did it from where they were. They didn't feel like because they weren't in one of the startup hubs, they couldn't really take a shot.
Tim knows I'm obsessed with Shark Tank right now. And it does have that quality of what you guys have done. You've done competition, and it just amazes me. It's people like that. Either something happens to a family member, just something in their walk of life, and they're just like, we can figure out a solution to this, and there it goes.
And one of my favorite examples is in Chicago. Eric Lefkowski started a company called Tempest, and the reason he started that was about 7 years ago. His wife was diagnosed with breast cancer. And they talked to a lot of people, different hospitals, and kept getting different opinions. So his wife's life was hanging in the balance, and different people were saying you should do different things. He said, well, this is kind of a data problem. You need to be more precise in what exactly is going on with her situation, and therefore what would be the best possible therapy to help her. And that company now has gone on to hire more than 1,000 people, a lot of data scientists coming out of University of Illinois, raised $1 billion. It's a really great company, and it would never have happened if Eric didn't have a wife that was struggling with this disease and was getting differing opinions. So this really is the story of entrepreneurship. It's just part of the reason to write the book is the story for too long has been limited to a few places in Silicon Valley. Mark Zuckerberg, Elon Musk, they're the celebrated tech entrepreneurs. They should be celebrated, but we need to also celebrate the entrepreneurs all over the country that also are doing things in new ways.
I mean, how about your story, starting AOL? You didn't start that in New York or San Francisco.
Yeah, we were outside of Washington, D.C. in Northern Virginia. It was not by any stretch a startup hub. There was no venture capital there. It was hard to get people from big companies to join a little startup company. So it was a struggle. I think that helps inform my thinking around the rise to rest and maybe passion to make it easier for the next generation of entrepreneurs wherever they are in the country. But for the first decade, it was a struggle, and a couple times we almost didn't make it. Finally, we broke through, and obviously it ended up being a successful company. But many entrepreneurs in many parts of the country would never take that first step to start a company, or if they did, they wouldn't be able to raise the capital to make it a go of it, or wouldn't be able to hire the talent. We've got to change that. Otherwise, we're going to have a even more divided country and probably run the risk of losing what is now a global battle around innovation entrepreneurship.
You have seats at the table where you can help change that. I mean, what is it that needs to be changed? Is it something to do with incentives from the government? Is it something that the private sector needs to do and wake up? I mean, what is it that needs to change so that there's more acknowledgement? And maybe resources going to this.
Mostly, I think the private sector. There are some things the government has done, and some other things government should do. A decade ago, I worked on the Jobs Act, legalized crowdfunding, which helped create some opportunities to raise capital. Just this summer, the legislation, the CHIPS and Science Act, included funding of about $10 billion for regional hubs, which will help support the rise of the rest. So there are some things that happen at a national level, even at a local and state level, that I think are important. But ultimately, it's the people standing up saying, I'm going to create a company. There's something I want to do, there's some problem I want to solve. I'm going to create a company, and then getting investors to back that company. One encouraging data point, and we got this data last year from a partnership Rise of Rest did with PitchBook. In the last decade, 1,400 new venture capital firms were started in Rise of the Rest cities, meaning outside of San Francisco, outside of New York, outside of Boston. That bodes well for this next chapter, because having some of that local capital is really helpful to these entrepreneurs.
Why is that happening? Are people just acknowledging what's going on in some of these hubs, or what is it? Or is it hard to compete on the coasts for?
Yeah, a bunch of factors, but the core is people recognize this next phase of innovation is going to be a little different, that some of the cities around the country that weren't really part of the innovation economy in the last couple of decades are well positioned, and therefore there's great opportunities to back those companies, and investors want to capitalize on that. So that's the main factor. It also helps that we're starting to see some real breakout successes. A company like MailChimp was acquired in Atlanta last year for $12 billion.
It's real money.
There are a lot of these companies that are starting to scale around the country, go public or be acquired for pretty significant valuations, which lead the investors to say, maybe I should be paying more attention to some of these other places. Somebody out there is making a lot of money. Maybe I should do a little less and have a little more diversification, not have all my eggs in the Silicon Valley basket, have other investments around the country.
Are wealth funds in general, like Tim and I talk to so many different wealth managers, and I feel like so much of their investments is looking for kind of some of these startups. Does that help fuel the momentum that's going on, where it might be too pricey for them to get in on some of the deals that are typically led by some of the coastal firms, if you will? Is that part of it?
I think it could be part of it. A lot of the capital is still invested in funds, and as opposed to directly in companies. So getting more funds started in more places, I think, is the best solution. As the companies scale, some of the investors in those funds also look for co-investment opportunities in some of those companies, and we're starting to see more of that. But anything we can do to get more capital in the hands of more entrepreneurs in more places, I think is supportive of this overall Rise of the Rest effort. Will also help in these communities create more jobs and opportunity, which also, and at least in a small way, could help unite a very divided country. Part of that divide, not all of it, but part of that is this opportunity gap, where some people are doing well, and a lot of people feel left out and left behind. How do we give those people more of a shot at the American dream?
It's funny that you say that, because we were talking with the author of a new book out that's about the Proud Boys, and just how there's predominantly white men in the United States who are just so angry and feel like that they've been left behind. And you look at some of the statistics, and when we talk about wealth creation, we know that there have been a lot of individuals left behind. So maybe a way to fix
and it goes back to even the core thesis of the Rise of the Rest book. If 75% of venture capital goes to 3 states, which is what's happened over the last decade, and a lot of other states, including big ones, Texas, Florida, Illinois, Michigan, these are 1 or 2%. Then there's fewer new companies started, fewer new jobs being created. And some of the disruption on the coast, a place like Silicon Valley, is actually because of automation, productivity, is actually destroying jobs in many of these communities. That's inevitable. It's going to happen because of new innovation. 100 years ago, 90% of us worked on farms. Now it's 2%. That's because technology allowed you to grow more food with fewer people, which is a good thing if you're trying to efficiently feed the world. The difference, though, is we followed that by backing new companies that created new jobs, and that's what we've missed out on, and that's what we have to address, and that's why I wrote the book. Hopefully that will lead more people to be inspired to start companies, more investors inspired to back those companies, more mayors and governors focused on supporting those companies, and you'll see these startup hubs, not just in 1 or 2 cities, but in dozens of cities. That's really what I think will happen.
So, Steve, let's say a recent graduate or somebody in college right now is listening to this interview, and for years, recent college graduates have been told to, go west, go east, go to the big cities. That's where the opportunity is. Give us the top 3 places where you think this college graduate should consider to move.
Well, I'm reluctant to pick cities because it's a little bit like asking who's your favorite child. We've now visited
That was our next
43 cities.
We might
with
head back
bus,
on those buses.
Have 100 different cities we've invested in. Of course, we're championing all of them. But I think the simple answer, it depends what they want to do. It depends what industry they want to disrupt. But rather than presume they have to go someplace else, maybe they can stay where they are. We've seen the data in the last few years. It's been encouraging that graduates from, say, Carnegie Mellon, which is a great university in Pittsburgh, a decade ago, most went to the coast. Now more are staying in Pittsburgh. We're also seeing that in Ann Arbor. The University of Michigan is also a great university. Many great universities around the country. So rather than presume once you graduate you have to leave, the opportunity is better somewhere else, the grass is greener somewhere else, look at your own backyard. Chances are there are things happening that you can be part of that doesn't require you to. If you choose to move, so be it, but don't presume you have to move. That's what's changed in the last decade. I think anybody reading this book would see that that's really happening everywhere.
What was, in reading your book and just looking over it, you had said it's not just about great ideas. And I'm just wondering, what is it as you travel around the country and travel through the Heartland, what is it that says, okay, that has potential, or that individual has potential, or that idea has potential?
Well, some of it, the ideas we're looking for are taking on some of the big aspects of our lives, big industries, with a better way to do it. Some new idea that is just a better path forward. So that innovative idea is important. What's also important, though, is the team you assemble around the idea. Sometimes we celebrate the entrepreneur too much, and it's really a team sport. How do you get the right team? So we look at who else is on their team, and we look at, for at least early evidence at the early seed stage, that there's sort of this product market fit. There actually is some enthusiasm about that idea. So there's a mix of factors, but it starts with having a big idea, but then having the team and a strategy to really capitalize on that idea.
Give us an idea of, I don't know, something that you passed on in the process of this that has turned out to be really successful, that you look back and say, I wish that was one we would have invested in.
Well, we've passed on a lot of things, not just with Rise to Rest. I'm not sure. When we do pitch competitions, there's about 100 applicants in every city. 10 end up pitching. We then invest in one. Sometimes we go back and invest in somebody that didn't win. I'll give you one example. In Atlanta, a company called Hermias was sort of one of the runners-up, but we were quite taken with it. And basically, it's a company focused on building Mach 5 engines and then jet planes. The Air Force is now a customer. They've gone on to raise significant capital, including from some coastal investors. So even though we initially said no, we turned around a month later and said we actually, whoops, we want to get in, and so we did end up investing in that company.
One of the things, I love talking with individuals like yourself who are in the VC space or in the investment space and just looking at kind of what are the trends and ideas that, I don't know whether it's 5 years from now, 10 years from now, or 20 years, where you make the investment today and it's going to be a big part of the world. How should we be thinking about that? What kind of catches your interest when you think about that?
I think it is the most important aspects of our lives, which I think I wrote the book, previous book, The Third Wave. It talked about the first wave, getting everybody online. The second wave was software on top of the internet. The third wave was going to be the internet meeting the real world. That's the phase we're now in. So I'm talking about things like healthcare, food and agriculture, transportation, financial services, a lot of different things that are being reimagined. So that's the first place to focus. And then recognize that some of the partners you need, some of the expertise you need is not on the coast. It is in these different parts of the country, and either start there or move there to really capitalize on that expertise. There's a lot of examples of people deciding to move. One, actually, somebody was started in New York City, a company called Temperback we backed, that's focused on sustainable packaging. Styrofoam's terrible for the environment, but people have to keep stuff cold, whether it's food companies or pharma companies. They created a better packaging, and they moved to Richmond, Virginia to launch that company. And just a few months ago, Goldman Sachs led a $140 million round to that company in Richmond, Virginia. So that's an example of looking for a better way and then saying, even though they were in New York, or the Acre Trader founder was in San Francisco, saying, is that the best place for me to launch that company? In more and more situations, we're finding that's not the right answer, and entrepreneurs are going to other places and that's why the rise of the rest is accelerating.
One word I didn't hear come out of your mouth yet has been crypto. And the reason I thought of it is because you talked about the first wave and the second wave. And I think a lot of people might hear that and think, okay, well, Web 1, AOL, Web 2, applications on top of that, access to the internet, Facebook, Phase 3, Wave 3, Web 3, crypto and the metaverse. It's interesting that you define that third wave as being something that's real, something that's physical, where the internet actually meets the real world, not necessarily us being transformed into this sort of virtual world.
Yeah, no, I think there are a lot of interesting things bubbling in Web3, which has become a rather large and varied basket of things running from crypto, Bitcoin, blockchain, NFTs, metaverse, a lot of different things. Some of those will end up scaling and being pretty significant. Others will end up not having the traction that people thought, which is always the case when there's new technologies. And I can relate, particularly on the metaverse point, because we launched the first graphical kind of multiplayer game, kind of a metaverse, a virtual world, over 30 years ago in partnership with Lucasfilm, 35 years ago.
Wow.
It's called Lucasfilm's Habitat. It was for Commodore 64 computers and 300 baud modems. And basically you're walking around living in an alternate world.
There's a whole generation that doesn't know what a Commodore is.
I totally know what they don't know. But the point is that things like the metaverse are evolutions of things that were started early, which is, again, always the way it is. So I think there's some really interesting things bubbling in that space. I think that there is a real focus now on what are the things that really are going to scale, and how do you simplify some of these, because a lot of people are confused by the varied options.
So when it comes to something like the metaverse, is it that we really don't quite know what it is, so it's hard to really make maybe a smart calculation or thought in terms of the impact on it longer term?
Well, there's a mix of things. Some of the use cases so far that have gotten traction are obviously in the gaming space, and that can be pretty compelling. We're also seeing, I'm the chair of the Smithsonian. My wife, Jane, chairs the National Geographic Society. There's some things
that are being... joining us tomorrow.
I heard the guest tomorrow. Gene Hayes from Nat Geo and the Case Impact Network tomorrow on Bloomberg Radio.
Well done.
You're
hired.
So there are some things there that are helpful as well. And there have been also some office applications trying to create virtual meetings that are much more compelling, much more immersive than Zoom has been. So there are a lot of things that are interesting that are bubbling, and the technology is advancing, pretty significantly. But I think a lot of people still feel there's a little more work to do to really have those breakout, killer applications and the technologies that allow you to participate in these virtual worlds without sometimes getting motion sick, for example.
Yeah, exactly.
We're talking to you on a day where the S&P 500, hit a new low, back at levels last seen in November of 2020, down close to 24% for the year. Give us the macro view when you look out of the landscape and what you're seeing right now as far as opportunity. And are you concerned in an environment like this?
No, I was more concerned a year ago when valuations struck me as kind of at sort of unsustainable levels. We actually, with our Revolution Growth Fund, slowed the pace of new investments and accelerated the pace of essentially monetizing some of our existing investment. We just thought after a 13-year bull market, things were a little bit out of hand. So I'm not surprised by at least personally, by the reset. The dynamic that I've seen now play out several times is when there is an economic, some economic pressure, big companies tend to move from offense to defense. They look for cost cuts. Often the first things to get cut are some of their long-term innovation projects. What that then means is instead of those big companies investing in those, new companies, startups, can basically have more, kind of an opportunity to challenge some of the incumbents. So I think this could lead to a flourishing of entrepreneurship in a lot of different sectors. We're just trying to make sure it's done in a much more inclusive way. So Rise to Rest cities and companies really are the ones that get access to capital and can challenge those big incumbents.
We're talking with Steve Case. When you talk about flourishing, I also do think about geopolitical and the war in Ukraine and how we're thinking how we have to speed up the move to alternative energy ultimately, because Europe in particular just getting crushed. How do you think about it and how that impacts maybe where you want to invest, particularly climate change, energy, which are going through some major disruptions right now?
Climate is shifted over the last couple of decades from being a problem to solve to being an opportunity to seize. Everybody now, not everybody, almost everybody acknowledges there's a real threat there. But rather than just tell people what they shouldn't do, what's happened in the last few years is a lot of entrepreneurs have launched new companies to really deal with it in a much more significant kind of way. So there's a acceleration of investment in what we call climate tech. That will accelerate further because some of the legislation that passed Congress just in the last few months, particularly the built into this Inflation Reduction Act, the IRA, with some funding around climate, as well as some of the funding in the CHIPS Act around regional hubs. So those, I think, are both opportunities for an acceleration acceleration of more investment in innovative solutions to deal with the climate challenge. And some of the companies I mentioned, like Temperpack, are angles on that are really trying to create a more sustainable future. So I think there's now a rush for both entrepreneurs to start companies and investors to back companies because they realize this is one of the great industries of the future.
20 seconds. What should we ask your wife? What should we ask Jean?
Well, she just came off a retreat in Africa with the National Geographic Board in Botswana. The first time I think the board had ever done a retreat in a 135-year-old organization. So she might have some thoughts on that. And also, she launched about a year ago the Case Impact Network and a newsletter, which I'm sure she'll talk about, is trying to inform particularly young millennial investors about things that they might find helpful.
Well, looking forward to that, and we were so looking forward to sitting down with you. So thank you so much for such an in-depth conversation. Maybe we can get the two of you at some point.
All right, let's do it.
Steve Case, of course, co-founder of America Online, chairman and CEO of Revolution, his new book, Rise of the Rest, How Entrepreneurs in Surprising Places Are Building the New American Dream. This is Bloomberg.